All right, let's get into it. You know when you see a Wall Street analyst report and it feels like it's written in a totally different language? Well, today we're going to crack the code. We're taking an actual report from Goldman Sachs and breaking it down piece by piece. Now, just a heads up, this isn't investment advice. Think of this as learning the language of financial analysis, so you can see the real story hiding behind all those numbers.
So check this out. This one sentence, this is the actual title of Goldman's report on a company called Futu Holdings. And it's not just a title, that's pretty much the whole story right there. It's a classic case of mixed results. You've got the good news, strong prints on client AUM growth, but then comes that pivot word, despite, which is analysts speak for but wait, there's more. And the but is that new user growth was just okay. So right from the get-go, we're being told to expect some really impressive stuff and some kind of average stuff. Let's unpack that. So just like the analysts did, let's start with the good part, those strong prints. This is the stuff that really got Wall Street's attention. The numbers that didn't just meet expectations, they blew them out of the water.
And this is where things get really interesting. Look at the sheer scale of this surprise. Total revenue? The company brought in 5.1 billion Hong Kong dollars. That's 22% more than Goldman themselves thought they would. That's a huge beat. But the real jaw-dropper? That's net income. The estimate was 1.4 billion, and they actually hit 2.6 billion. That's a 78% beat. That is the kind of number that makes headlines.
Okay, so the title specifically mentioned AUM growth. What is AUM? Well, it stands for Assets Under Management, and it's basically just the total amount of money that a company is managing for all of its clients. You can think of it as a measure of trust. The more AUM you have, the more people trust you with their money, and the bigger your business is. It's a really key health indicator.
And for Futu, that number is massive, 974 billion Hong Kong dollars. We're talking about almost $1 trillion here. So this is no small-time operation. This is a serious financial player.
And this chart just nails the point home. This is why the report's title called out AUM. Look at that gap between what Goldman thought the AUM would be and what it actually was. That difference is a 13% beat on what was already a huge number. This growth in client assets was the engine that drove those incredible revenue and profit numbers we just saw.
Okay, so that was the fantastic news. But a good analyst never just looks at the headlines, right? Remember the second half of that title? Now it's time to look under the hood at the numbers that were, let's say, a little less spectacular. This is where we find the nuance.
Here we go. The company added 204,000 new paying customers. Now, that sounds like a lot, but the key phrase here is in line. In Wall Street language, in line means it was fine, it met expectations, but didn't beat them. There was no surprise here. And for a growth company, sometimes just meeting expectations isn't quite enough to keep the excitement going.
And here's another subtle but really important clue. The margin finance balance, which is basically how much money people are borrowing to make bigger trades, was actually down 11% from the estimate. The report calls this deleveraging. It might be a sign that customers are getting a little more cautious, which could affect how much they trade in the future. It's not a red flag, but it's definitely a yellow one. So, you have soaring profits on one hand, and just sort of meh user growth and cautious behavior on the other. How does an analyst take all these conflicting signals and come up with one single conclusion? Well, that's where we get to the verdict, the rating and the price target.
And the final rating is neutral. A neutral rating is the analyst's way of saying, look, we don't see a huge reason to run out and buy this stock, but we don't see a reason to sell it either. It perfectly captures that mixed bag of data we just went through. The good stuff wasn't quite good enough to totally outweigh some of the underlying concerns.
But this is where things get a little counterintuitive. Even with that neutral rating, look at the price target. At the time, the stock was trading around $168, but Goldman's target for a year from now is under $125. That's a potential downside of almost 26%. So this tells you that even though the analyst isn't yelling, sell, they think the market has gotten way ahead of itself and that the stock is probably overvalued.
Every report also has what's called the bull and bear case. It's basically the analyst saying, here's what could happen that would make our prediction wrong. And notice how the risks are just the mirror image of the key things we've been talking about. The upside is if client and AUM growth is better than expected. The downside is if it's worse. This is like a roadmap for what to watch in the future.
Okay, so now we get to what is, in my opinion, the most critical part of this whole exercise. After you've looked at the numbers and the verdict, you have to read the fine print. This is the stuff you absolutely cannot ignore.
You'll see this sentence, or one just like it, in pretty much every report. And it's so easy to just gloss over it. But don't. The firm is telling you, right up front, that their relationship with the company they're covering is complicated.
And it's our job as readers to figure out what that means. And here are the specifics, pulled from the back of the report. First, Goldman owns over 1% of the company. Second, Futu is an investment banking client. Third, Goldman hopes to get more business from them soon. And fourth, Goldman actually facilitates trading in Futu stock. Now, this does not mean the research is wrong or biased, but it gives you crucial context. It tells you Goldman Sachs has a deep, multifaceted business relationship with Futu, and this analyst report is just one small piece of that much bigger picture.
So there you have it. It's really a four-step process. 1. Start with a title to get the big picture story. 2. Find the proof in the numbers, both the good and the bad. 3. Understand the analyst's final call, the rating and the target. And 4, and this is the most important one, always read the disclosures to get the full context.
So I'll leave you with this to think about. When a report is this transparent about the complex business relationships behind the scenes, what does that really tell us about how to read financial research? It's less about finding a simple buy or sell signal, and more about learning how to be a critical, informed reader. Something to chew on. Thanks for tuning in.